All right, welcome to the webinar today. Thank you for joining us. We'll just get started in a few seconds.
Hi, everyone. Welcome. We're very happy to have you here. Thanks for taking time out of your busy day to join us. Just waiting for a few more people to join and we'll get started, as Omar said. All right, I don't want to keep anyone, so we'll just get started. Good afternoon. Not sure where you're all joining from. I'd like to welcome you all today to this webinar. I'm Gretchen Ferguson. I'm the Director of Education and Consulting Programs at an organization called Vantage Point in British Columbia in Vancouver. Some of you may be familiar with us. Hopefully many of you are. So we actually bring together the nonprofit sector in BC for connecting and capacity building. We are the hub for the BC Nonprofit Network, from which we do peer communities to learn from one another. We do advocacy toward the provincial government on topics of mutual interest. And we also provide workshops, multi-day labs, consulting services across governance, leadership, and organizational capacity. So we have partnered with ENCL to bring you this webinar series, and Omar will talk to you more about that. And we're also partnered with ENCL around our membership. So if you are a member of Vantage Point, you also receive benefits in relation to ENCL. So we're really, really pleased to bring you this webinar on financial planning in uncertain times. We all know that this is a very uncertain time worldwide in general, and therefore also specifically in specific ways for the nonprofit sector. So without further ado, I would like to turn things over to you today, Omar.
Thank you, Gretchen. Really appreciate you having us here today and all of the work that we do together. Let's dive in here. All right. So a little bit about myself. Omar Vizra, I'm co-founder and CEO of Ankle. I started Ankle just over a decade ago. I'm a CPA CA by trade. And today I have the good fortune of working with a really diverse group of clients in the not-for-profit sector. So really excited to be presenting to you today. I do also want to stop and really appreciate the great work that Gretchen and her team at Vantage Point do. This year, we're partnering more extensively with Vantage Point. So we have a webinar series, so stay tuned for the next one, which is coming up. And we also have, it's become an annual event, our summer social. That will be held in August. It's an in-person event, not a whole lot of in-person events happening at that time of year. It's a nice time to get together with your colleagues from the not-for-profit sector. We have yet to announce the date and location, but that will be coming to you very soon. Again, Gretchen, thank you for having us. Let's get things going. The agenda for today, and as I was looking at this, I was thinking, oops, sorry. This doesn't look like a very extensive agenda, but it actually is. We're going to be talking about the uncertain landscape, cash flow forecasting, scenario planning, board reporting and metrics, building financial resilience, and we will leave some time for Q&A. Now, these are big topics. We could do a webinar on each of these on their own. I actually think we have. So we will keep things relatively high level, but again, if there's anything that we can do to support you, please feel free to reach out to us and we will make our contact information available to you. A little bit about Ankle. What we do at Ankle, we really, our primary goal every day, what gets us out of bed, is to help organizations gain clarity and confidence in their finances. We have about 300 clients today across the country, over 100 of which are not-for-profit organizations. We really think of our business in two distinct streams, one being financial operations, which is bookkeeping, payroll, and accounts payable processing. This is all of the routine stuff that keeps your organization going throughout the year. And then there's financial management support, which includes CFO advisory and controllership services. So the strategic things around controls, governance, those higher level finance questions that you might have. I would like to acknowledge that our offices where I'm located today in Vancouver are situated on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh nations. We're grateful to live and work on these lands and recognize our responsibility to learn from and respect the Indigenous communities whose stewardship continues today. At Ankle, we're committed to ongoing reflection and learning as part of our journey toward reconciliation. So, just getting clear on where we are. What are we seeing? Organizations today face complex financial operations challenges. These are some of the factors. So, resource constraints, limited budgets for full-time financial staff is really putting a lot of strain on the finance department in accounting, compliance, and strategic financial management. There are rising regulatory requirements from a compliance and audit perspective. Audit standards demand high-grade financial management and documentation. Then there's leadership expectations. Boards and executives require timely, accurate financial reports in order to make informed strategic and governance decisions. There is a drive towards focusing on strategy versus administration. Leaders are being asked to spend less time on financial tasks and instead focusing on growth, strategy, and core operations. And then there's cash flow management. Variable revenue streams and seasonal cycles create unpredictable cash flow that makes planning challenging. So, where do we go from here? Many organizations are turning to alternatives in how they manage their finance. There is a shift occurring where not-for-profits are realizing that there's an opportunity to partner with organizations that provide comprehensive, reliable, and consistent financial support at predictable monthly fees. So instead of recruiting, training, and retaining specialized finance professionals, you can find a small team on a fractional basis of finance experts to solve all of your financial operations issues. The benefits you get in partnering with an organization like ours, one is expertise without the full-time costs. You get access to CPAs, controllers, financial specialists, all on a fractional basis for the cost or less of hiring a full-time person. You get continuity. So the risk of turnover, knowledge loss when staff members leave is mitigated. Technology integration, we're always testing new tools. We have a core technology stack, and we are always looking at new ways of bringing better technology to our clients. And ultimately, scalability in this environment, scaling up or down and being able to do so quickly in response to budget cycles is important. So let's dive into the current landscape in a little bit more detail, and then we'll get into some of the opportunities for improved financial management. So nonprofits are operating in uncharted territory. The financial environment has fundamentally shifted. We've seen a lot of, I would say, micro shifts over the last decade, but really the last couple of years, where the funding environment has been quite drastically changed, altered, has had a significant impact on what we're seeing in the market. So first and foremost, here we have the shifting funding landscape. Government priorities are changing. Grants that existed in previous years may not be there, or they may be drastically reduced. There is widespread economic uncertainty, interest rate volatility, recession risk, and sector-wide financial stress. Rising operational costs. We have gone through in recent years a period of significant inflation, significant as compared to the previous couple of decades. We've seen increased wages, and we continue to see pressure on wages. Rents and program delivery costs have really increased significantly quicker than revenue growth. The regulatory environment is demanding more from not-for-profit organizations. Funders and the CRA are demanding a higher degree of accountability and reporting compliance. And then there's donor fatigue. There is increased competition for donations and growing pressure on individual giving, all at a time when consumers and individuals have less money to spend. So the planning paradox, I think this is a really great way of framing it. What we're being told to do in not-for-profit organizations is to build a detailed annual budget, set multi-year financial plans, forecast revenue with confidence, and maintain stable reserves. What's actually happening is funding is being confirmed on much shorter notice, maybe 3 months into the year even. Revenue streams are volatile and unpredictable, and boards are asking for certainty that in many cases does not exist. So, what do you do? Let's talk about this in a few distinct sections. So, first, we'll cover cash flow forecasting and how to build visibility in uncertain times. So, interactive poll time. I love this. How far ahead does your organization currently forecast cash flow? We have five options here that I will read out to you. One, we don't have a formal cash flow forecast. Two, 1 to 3 months. Three, 3 to 6 months. Four, 6 to 11 months. And five, over 1 year. Let's see what you have to say. Okay. Let me read these out to you. So, 33% of you said we don't have a formal cash flow forecast. 10% said 1 to 3 months. 8 said 3 to 6 months. 21% said 6 to 11 months. And 27% said over a year. So, really weighted between we don't have a cash flow forecast or the other extreme of planning for 1 year or more. I think what this really demonstrates is there is, cash flow forecasting is not something that is widely done on sort of a short-term, near-term basis. And that can, in this environment, be quite critical where things are changing quite dramatically. So let's keep going here. Cash flow, we know, is the lifeblood of your organization. One thing that I have really seen a lot of in recent years and is that you can be profitable on paper or you can be solvent on paper and still actually run out of cash. A startling fact here is that 52% of nonprofits have 3 months or less cash on hand, and 18% have just 1 month or less. And this is anecdotal because of course, I see many not-for-profits, current clients and future clients. But I'm seeing more of this where you look at the cash balance and it is dramatically low. So just further on this concept of you can be profitable on paper and still run out of cash. Let's just set the context a little bit. How do you avoid surprises? Well, know weeks in advance when cash will be tight, not days after payroll bounces. That's the position you want to be in. You want to negotiate from a position of strength. You want to approach funders and lenders proactively, not in crisis mode. You want to make confident decisions, know whether you can hire, launch a program, or invest in infrastructure. And finally, you want to satisfy the concerns of your board, give trustees the visibility that they need to fill their fiduciary duties. So let's dive a little bit deeper. What do you need to do to build a practical cash flow forecast? So I almost actually see the 1 year plus cash flow forecast as different from the operational cash flow that you would use sort of month to month. Well, what would you include in this operational cash flow? Well, you would, of course, start with your opening bank balance, expected cash inflows, grants, donations, earned revenue, government transfers, and expected cash outflows, payroll, rent, vendor payments, program costs. And what is your closing balance and minimum threshold? So look, have a running balance. What is the point at which you're going to have stress potentially on the organization? And how do we make this work? Well, you want to keep this up to date, particularly in a time of cash flow uncertainty or where you're down to that 1 month mark in terms of cash flow reserve. You want to update this weekly, not monthly. Use your accounting software as the data source. And of course, make sure that that data source is up to date. You want to flag weeks where cash drops below this minimum threshold. And I would, encourage you to have conversations about what this minimum cash threshold is with your board. And of course, share a simplified version of this with your board monthly, but demonstrate to them that you do have this in place. And assign ownership, who updates it and who reviews it. It depends on where you are, what your cash reserve is, your level of comfort. But this is probably something that as a leader in a not-for-profit organization, you want to stay relatively close to, even if you're not the one preparing it. All right, let's talk scenario planning now. Scenario planning is particularly interesting when there are times of uncertainty. Let's first jump into a poll here, though. Does your organization currently use scenario planning in its financial process? I'll read out the options here. One, yes, we have formal, best, base, and worst case scenarios, so 3 scenarios. Two, informally, we think about it but don't document it. Three, no, we use a single budget forecast model. And four, we're not sure where to start. Let's see what you have to say here. All right. Interesting. Okay, 24% say, yes, we have formal, best, base, worst case scenarios. 24% say informally we think about it but don't document it. 44% say no, we use a single budget forecast, and 7% say we're not sure where to start. So it does sound like there's some thought going into this, generally speaking, but a lot of organizations are not doing this. And I'm not actually surprised by these numbers. In fact, I think these are maybe a little bit better than I would have thought that we would have seen. Um, Scenario planning can take your finance function from reactive to resilient. And to be clear, it's not about predicting the future, but it's about being ready for what might come your way. So, what we typically see is scenario planning is limited to somewhere between 2 and 3 versions of your financial future or your budget based on different assumptions about revenue costs and external conditions. So, it's those big variables. It's not just about minor swings, it's about the things that can really move the needle. Let's say a loss of a third of your funding if one of your funders, um, pulls their funding, or a really poor um, giving season, let's say. So what it's not about being pessimistic or creating fear. It's about giving your leadership team options and a clearer decision-making framework. Organizations that plan for multiple scenarios are ultimately able to respond faster, waste less time in crisis mode, and maintain stakeholder confidence when conditions change. If you think about it, when bad things happen, there are a lot of emotions at play. There's a lot that can cloud your judgment and the judgment of your board and other key stakeholders. If you're able to think about best case and worst case scenarios in advance of this, you can make quicker, more level-headed decisions when things go different from the base case. So the 3 scenarios every nonprofit should model, and I should be careful there. Not necessarily every nonprofit should model this way, but this is what we see most often applied. I'd say there could be an argument for a fourth, depending on your unique situations, or two, perhaps. But there's the base case. This is your typical budget. In ordinary times when you had one budget, this would be your base case. So current funding and revenue holds relatively steady, costs increase modestly, no major program changes. This is uh, useful for day-to-day operations and board reporting. Then there's your stress case, one major grant delayed or reduced significantly, as an example. Unexpected cost increase, perhaps. Maybe it's a dramatic change in rent or staffing. And this can be used for triggering early warning and conversations with the board. So again, it's unlikely that any of these scenarios will play out exactly as you plan, but you can start to see directionally when you're headed into this territory. And then you can use this as a tool to have the right discussions at the right time. And then there's the crisis case. There's the loss of 30 to 50% of revenue, forced program reduction, or restructuring. You would want to use this for board level contingency planning and reserve policy decisions. Now, you may also have another case of, a best case scenario. Maybe there's a funding source that may change your revenue trajectory in the other direction. And it would make perfect sense to have that in place if you think that there's a possibility that that will materialize. Let's talk board reporting and metrics. More and more, we're seeing that boards are uh, not as excited, perhaps, is the way of putting it, over looking at reports coming out of QuickBooks. They want clarity and understanding based on where the organization is and what really matters to the organization based on its strategic planning. So in the old days, I will say, board reports were sent out 2 days before the meeting. There was a line-by-line variance analysis on, minor $500 discrepancies, a static balance sheet that doesn't show cash runway, and the whole, we're profitable or we're, balancing our budget, but cash is tight. What we're seeing more of and what we're seeing boards ask for is really a limited number of pages, visual dashboards summarizing financial health. Focus on a handful of key metrics that drive the organization forward and towards its strategic goals. Forward-looking cash flow projections. Boards want to say, or they want to hear, here is our runway and these are the decisions we need to make and that we need to discuss. So I can't say there isn't a prescriptive set of metrics that every board or every organization should track. These would be the ones that I'd say we're seeing most often these days. So the first is cash runway, which is the number of months your organization can continue to operate using only cash on hand, assuming no additional revenue. Two, operating reserve ratio, so available unrestricted net assets divided by annual operating expenses. This indicates long-term financial stability. Remember, I was talking about how you can have cash in the bank, but be insolvent. This can, if you don't watch your operating reserve ratio, you can actually be in trouble without even realizing it. Third, revenue diversification. This is becoming an important one. So the percentage of total revenues coming from your largest single source or funder, or instead of mix, and I have an example of your funding sources. You can also show this over a period of time. Many organizations we're working with, of course, are trying to diversify their funding sources. If it's one grant, that's 90% of revenue. How do we take that to 75, 60? You can start to see this visually and it can be quite powerful. Four would be program efficiency ratio. So program expenses divided by total expenses, which shows how much of your budget goes directly to your mission versus administration. And then there's budget variance. So actual revenue and expenses compared to the budgeted amounts year to date. This identifies areas needing immediate attention. This is always nicely complemented by a forecasting model that basically says, here's where we are year to date. Let's layer in where we think we're going to be at the end of the year. Where do we think we're going to land by year end? I'm just going to give you some examples of uh, inputs that you can add to your board. These are all done with software that plugs into QuickBooks Online and Xero. So these are tools that we can help you get up and running with and sort of customize for your liking. This is a more limited view of the profit and loss with budget versus actuals. And then there is fundraising efficiency. So this can actually get quite interesting. We can go down to the micro level. We can look at specific campaigns as an example. How much fundraising revenue did we have versus the associated expenses? Here is on the right-hand side, the program efficiency ratio, unrestricted net assets year over year, and the administrative cost ratio. These are so much easier to digest than some words on a page. And so you really might want to consider what matters to the organization, to the board, which metrics and key performance indicators drive us towards our goals and our strategic plan. Put those together, and you can start telling much better stories with your data. Here's a revenue diversification example. So this is a really powerful one. Obviously, this organization has a significant portion, 85% of its revenue coming from one restricted grant. Again, how can you modify this? What is the organization trying to change? And you can start to show this visually. All right, let's talk about where you go next, building financial resilience. How do you do this at a practical level for long-term stability? Of course, that is the objective. Reserves. So reserves have historically, received a little bit of a bad reputation, but they are important. They're particularly important. They are a strategic asset in times of uncertainty. I think it's a good idea to shift the conversation where there is perhaps the perception that, maybe our reserves are too high, assuming, that does come up. But a clear reserve policy moves your board discussions from can we survive this to how do we navigate this? So the key message here is have policies around your reserves and revisit those policies. This may be a time when you want to increase those reserves, just given the uncertain environment. In order to do so, some simple steps to take. One, define the purpose. So distinguish between operating reserves, of course, for runway, capital reserves for equipment, and opportunity reserves for perhaps new programs. Set a target. And again, there's no hard and fast rule. Generally, we say aim for 3 to 6 months of operating expenses adjusted based on your organization's specific revenue volatility. And third, create a board policy. Establish clear board approval rules detailing how reserves are funded and the specific conditions under which they can be accessed. I would also say you may have these policies documented. Make a point of revisiting them once a year. So, where do you start today? Just to summarize and to sort of wrap up everything that we've covered today. And again, I am realizing just how heavy what we've talked about is today. And again, we've only scratched the surface. But one, build a week by week cash flow forecast. Start tracking inflows and outflows weekly in order to gain visibility into your runway and avoid surprises. Two, establish your minimum cash threshold. Determine the absolute minimum, and set alerts as you approach them. Model 3 scenarios. Again, it might be 2, it might be 4, but create your base case, stress, crisis, and maybe your optimistic scenario. And then fourth, redesign your board dashboard. So replace that 15-page financial package, which, by the way, it probably takes you a long time to put that together. Break it down to one page or a couple of pages. See how you can use software in order to automate parts of this process. So some key takeaways that I'd like to leave you with. One, cash flow visibility is more important than paper profitability. Two, scenario planning turns uncertainty into actionable options. Three, board reporting should focus on insight and runway, not just past performance. And four, reserves are a strategic asset that require a funded policy. We have put together this ebook here. This is geared towards year-end audit. Many of you have March 31st year ends. So audits haven't started yet, or maybe they're in their early days, or they will happen in the near term. Please feel free to download this ebook through this QR code. We will also make this available to you after today's webinar. Now, before we get into the Q&A, just a little bit more about our services. So I mentioned a little bit about this at the beginning. Core services are listed here: bookkeeping, payroll, accounts payable. That's the financial operations side. And then there's the financial management side, being fractional controllership and CFO services. As Gretchen mentioned, we do have some promotions for Vantage Point members. So Vantage Point members will receive $500 off onboarding with Ankle. That involves getting all of your systems, workflows, processes set up when we start working together. So there's a discount for that. We also do have a financial diagnostic report, and we do customize these a little bit. Typically, they cover financial technology stack opportunities for improved technology usage, bookkeeping health, and financial governance issues that might be impacting your organization. So we undertake a series of interviews. We do some work with you to put together really a snapshot of where you are and a series of recommendations. This can be a really great way of figuring out priorities and how to really strengthen and build a resilient finance function. Vantage Point members get a 50% discount on this. All right, let's dive into Q&A. Gretchen is going to ask me the questions that come, and I see there's quite a
I,
few
yeah,
here.
we have about 5 questions already. So
Great.
I'm looking forward to them. Thank you so much, Omar, for such a great succinct overview of some of the things that we can do to tackle really good financial management and practices and governance in these times. I think I really liked how you framed the importance of moving from reactivity to resilience, because it's fact that we're in this situation, but what can we do about it, right? So I love that emphasis. So I think we have some of the questions are really quite specific. You just ended with a question about reserves, so I'll start there, and then I'll go back to others. Different branches of government who issue grants have told one organization they have too much in reserves without specifying what they mean by too much. How would you
Mhm.
provide guidance on reserve level?
Yeah, that's a tough one. I'd love to get into more specifics. I think this, for one, can you have a conversation about it, of course, and you've probably thought about that already. But also, how do you demonstrate that those funds are needed and how you're going to use those funds? I think, and it really depends, right? It depends on what the reporting requirements are. It depends on the flexibility in the reporting template. There are a lot of variables there. But how you tell that story of what you will use those funds for. And I think finance plays a clear part in that. So building a forecast specifically to that one reserve, being able to isolate the costs and really being able to paint a clear picture of where you're headed, I think is quite important in this situation.
Right. Thank
That
you.
might have been a little bit of a high level
There isn't there.
response.
I mean, the
Yeah,
CRA doesn't have a specific percentage or amount that
right.
they say you can have, right? But they get concerned at a certain point, or
Yeah,
what's your
and
experience with that?
to be honest with you, I've worked even in the days when I worked in tax, you don't really find great guidance on this. They don't release, they don't disclose what those thresholds are. What does help, of course, is looking at your peers, right? Do
Mhm.
you have a peer in the industry that you can collaborate with? Is there a service provider that you're working with that works with other similar firms? Can they give you a little bit of a gut feel on where you are versus others? That's a tricky one, though.
Okay, no, that's good. Let's continue on then. Just there's a question about your specific services. If your programs, how you do your accounting, do they integrate with a nonprofit CRM so that you can track grants and donations coming in, grants paid out, and track granting for financial accounting purposes as well?
Great question. So generally, QuickBooks integrates with everything. This
Mhm.
is a really specific question, but I actually really like this
I,
one.
I can I actually do you
Yeah,
integrate with QuickBooks, right? Because we
I
actually
do.
we just integrated QuickBooks with our Salesforce
Okay.
by adding on another program called Breadwinner. So
Okay.
we just did that. They
You
didn't
integrated.
integrate
Yeah.
directly, but I just yeah. Anyway, carry on.
Yeah. So there's, yes, generally you can integrate QuickBooks directly with any CRM, or there's usually a connector available. Practically speaking, there are reasons why you may not.
Hmm.
And let me just get into some of that detail. So it depends on how developed the integration is, I would say. Generally, at Ankle, we encourage you not to have donor data in your accounting software. You want to keep your donor data within the four walls of your donation management platform. If you're able to have data exported at a high level, so donations for this campaign, $1,000, second campaign, $2,000. If you're able to have it um, push into QuickBooks at a higher level, I think it can be useful. But you also want to make sure that numbers can't change. So often, what we see is that the integrations are not well built. And so you finish your numbers, and then the historical numbers start changing for whatever reason. So I would say we evaluate this on a case by case basis. Often we don't integrate them and we just make sure we're clear on what report we're getting. We take that report, we book a journal entry in QuickBooks, and then we keep that report as support. So there's advantages and disadvantages, I would say.
That's very interesting. And I think, yeah, related to grants, for example, because you're referring to donors there, there's also
Yeah,
grants. I can also
yeah,
share that Vantage Point. One thing that we do is rather than having Salesforce update QuickBooks or QuickBooks update Salesforce, we simply can compare them through
yeah,
software. And so, and we also make sure that the records are linked through things like making sure we have certain fields filled in, right? Like
yeah,
invoice field is tied to a particular
absolutely.
grant, is
Yes,
tied to a particular contract, all of that, so that we can
yeah,
see them, but not have them actually updating each other for
right.
that exact reason that you said. I don't know if that's helpful. Um, this is another one that's quite specific, but I think really interesting is there a single report that shows profit and loss with budget variances? Is there a format for showing profit and loss with budget variances?
Yes, there is. I can picture it in QuickBooks. I don't know what it's called. Now, where this becomes challenging is when you're using classes in QuickBooks. So at a consolidated level, you can get this report quite easily. You can do it in both QuickBooks and Xero, but when you start looking at classes, it becomes a little bit more tricky and custom. There's some advanced reporting capabilities in QuickBooks Online Advanced, which can allow you to achieve it. There's also third-party reporting tools. The one that we're really excited about right now is called Fathom, and we've been able to achieve some standalone budget versus actual comparisons through it. So the answer is yes at a high level. If you want it at a program level, it can be tricky.
Okay, great. And we have a question related to organizations that are funded mainly through membership dues. So which is often, especially associations, for example, commonly the case. So dues tend to come in for them in the first quarter of the year. So how can they better map their cash inflows and outflows by month? They're really their cash flow based on all the revenue coming in a lump.
Yeah. This is one where you are going to want like a month by month cash flow because your cash is in some ways it's harder, but it's also very predictable. You know when you're going to get your cash and how it's going to sort of um, get consumed from there. So as much as we were talking about the sort of really active cash flow management, like looking at it weekly, this is one where the monthly, I think, is actually quite valuable, right? Where are we going to end up at the end of each month? And then if you have problem spots there, then, go micro, and figure out what that threshold is below which you and the organization are comfortable, and take specific action there. This is very common with member-based organizations, but I'd say the monthly approach is probably the way to start, at least.
Great. Um, and this is just a side question, but I suppose you could also do deferred revenue when you have a scenario like that, right? The same way you might with
Yeah.
a grant. I'm not sure.
So this is
I'm not an
another thing is
accountant.
how are your financial statements prepared? Do you recognize all the member dues as revenue when you get them? Sometimes, of course, organizations align it so that their member dues are received and, are recognized immediately and sort of there's no adjustments to do. But it does depend on your revenue recognition approach and how your financial statements are presented. This is a situation where cash flow and revenue can be quite wildly different, right? Like you could have straight line revenue, let's call it $100,000 a month, but you're getting $1.2 million at the beginning of the year and nothing at the end. That's when cash flow planning is most important, most valuable. When you have the same cash flow trajectory and revenue trajectory throughout the year, it's pretty consistent organization. That's when it's perhaps less valuable.
Okay, great. Thank you. I have a couple more questions here. And I think we're good on time. So, one is about I think this is forecasting. So for forecasting, or I assume budgeting as well. How do you forecast grant revenue if you've applied for it, but there's no guarantee of receipt? So do you put some kind of percentage assumption, or do you assume zero? How would you manage that?
Yeah, there's a little bit of an art to this, to be honest. How optimistic are you that you will get this funding? I would say don't bake this. It sounds like just based on the nature of the question that you're not overly confident, so I wouldn't put this in your base case budget. I would probably put this in one of your scenarios. And again, look specifically in order to sort of fill out this scenario. Maybe it's, 25% increase in revenue. Where would you put those costs? I think that's the best way to do it. Keep it out of your base case budget and create a scenario.
Yeah, I love that. We've got the questions coming in. We've got three more here all ready to go. And one is about scenario planning. So it ties to what you've just said. When you're looking at scenario planning and you're calculating cost increases, say 3 to 5%, is that increase calculated on actual current values or projected values in the budget that have the cost of inflation already built in? Like, is that added to inflation projections or not?
I typically consider that to be so I'm not sure I'm quite following the question, but the way I would drive that is what did we have last year? And what is the expected increase for this year, factoring in inflation? Um, there are expense accounts where you can just take a number, right? It's going to be 3%, 4%. There are other accounts and other costs where you don't want to take that blanket approach. Um, so be careful, I would say. Like there have been years, for instance, where we've seen software costs dramatically increase, right? You want to be careful to not just apply, a blanket inflation plus 0.5% or 1%, and here we go. You can do that in some cases, but get specific where you need to.
That's right. It depends on so many factors, right? For example, salaries. Are you giving salary increases and
Yeah,
what's around that? Or software tends to be higher than inflation because it could be driven
yeah,
by other factors like how many users you have or a
yeah,
bunch of different scenarios.
exactly.
So, and then another question that came in, I was actually I was going to just add in the question about the revenue recognition and the cash flow, one thing that we do at Vantage Point is if we've applied for a grant toward the end of the fiscal year, but we don't know if we're going to get it, we actually would put that in at zero. for
Hmm.
our budget for the next year.
Yeah.
But for what we call earned revenue, I don't know if other organizations have earned revenue. That might include member dues, for example. We have different percentages for our
Yeah.
forecast, depend on how certain we are. So we have a
Yes.
percentage for prospecting,
Yeah.
communicating, contracted,
Yeah.
etc. So, that is a way to do it too. You can sort of weight it based on how
Absolutely.
certain you
Yes.
are about the revenue and have
Yes.
a sort of standard approach to that. So
Yeah.
I'm sure that you do that as well. I just thought that might
So
be.
scenario, that's actually a really good point, Gretchen. Your scenario planning, I've kind of defined it in a very simplistic way, like, base case and then, 25% revenue increase on one because of one unexpected grant. You could have a more optimistic budget that
Mhm.
takes, 10 grants you've applied for and gives you sort of the magic on what that would look like based on
Right.
percentages where you feel confident.
Percent of certainty in a
Yeah.
sense. Yeah, yeah,
Yeah.
yeah. Or odds
Exactly.
of, yeah,
Yeah.
exactly. Okay, so then moving on to something about the reverses approach. So, do you have any tips on positioning the reverses approach when donors want to know where their contribution is going and that it's making a difference? I'm not sure. I'm not sure. Did you mention the reverses approach? I didn't.
Oh,
I'm sure if
no,
somebody
I'm
could
not
clarify that.
overly familiar with this concept, so my apologies.
Okay.
Um,
Maybe you could, maybe the person who asked that question could put a little bit of clarification. Oh, I'm sorry. It says reserves. I'm sorry, not reverses. Okay, that makes more sense. So let's try again.
sorry, what was
Uh,
the question
tips,
again?
tips on positioning the reserves approach, like so having reserves when
Yeah.
donors want to know where their contribution is going. Yeah, I guess that's how do you justify having reserves to donors? Because donors want to say like their money's being spent and it's having an impact.
Yeah, so we did some work on it's on our blog. There's a blog on impact reporting. And actually it was at the conference, Gretchen. That team did that amazing presentation on impact reporting. And that's where I would say that content is very relevant. It's all about the impact, right? And there's a little bit of an art here, but I remember leaving that presentation just so inspired by the stories that they were telling about reporting. So um, I would suggest having a look at that. I'm sure we have a blog post on it, but I'm sure Vantage Point has that content somewhere as well.
Yeah, let's share that. Let's share that blog for sure in the follow-up. But I mean, I think this is it's a complex question. I mean, it has
It
to do, we
is.
see this so much in the nonprofit sector
Yeah.
that funders always a lot, they want to see that short-term impact. They put in the money,
Yeah.
they get out an impact, and they think that
Yeah.
that happens through programs. And the fact is, if you don't invest in the core strength of your organization, which includes reserves, that actually you can't actually have the impact.
Yeah. Of
Like that actually is a piece of impact is investing in
course.
the sustainability of your organization.
Yes, absolutely.
So, finding ways to tell that as a story
Yeah.
rather than just showing we spent your money on X and then it served X number of people,
Yes.
I think is the key to that. But like you say, it's quite a complex issue because of how people view the nonprofit sector. They always think that if money's going to overhead or it's being saved, that it's not that it's,
Yeah.
I don't know,
I'm actually
wasted or
glad
something
you
like that.
raised that, Gretchen. You know, before I got heavily engaged in the not-for-profit sector, I would say that I came with a little bit of that bias when I would think
Mhm.
about where am I going to donate my money, right? It was always, well, what are their administrative costs?
Right.
And you're absolutely right. Telling that story is a little bit tricky, but it's an important one to tell, I think.
It's critical, and I think that all of us have to get better at it. Um, so here, another question we have is it says this is not a question we want nonprofit leaders to have to ask, and you may not want to address it here, but how do organizations survive and bounce back after reaching a crisis stage? Is it possible, particularly when the services are proven and high value impact? What's your experience in
Absolutely.
that?
Yes. Yes. Um, it's hard to comment without the specifics, but um, the great thing about the not-for-profit sector and is the people, behind organizations that care that are having an impact. And so I would say it comes down to look at the people that care about the organization, the people they're supporting the organization. How can you leverage your small community to bounce back? Um, I'd love to hear more about this and understand a little bit more of the specifics, but most certainly. And I think in the coming years, we're going to have a lot of those stories. I think we're going to have a lot to be proud of because I know there's so many people working hard and going through tough times and really, um, if I could add one piece of advice, it would be rational, be close to the numbers and understand where you are. Um, Recognize that you have to make some tough decisions, right? But those tough decisions are for the better of the organization and for the mission that you're driving forward.
Yeah, thank you, Omar. And there's no simple answer, of course, to that question. There are nonprofits, as we know right now, that are closing their doors from financial crisis. And I think you're trying, some of the things that you've shared today are to try and position them to not get to that point. But another framing that we use at Vantage Point and others use is the nonprofit life cycles approach. I know you're familiar with that, and it positions things too, not just as that an organization reaches a crisis, but that all organizations go through processes of getting to like
Yeah,
maturity where their programs are really solid and impactful, or not all, but I mean, they'll often get there. Then they can get to kind of a transition point, and at that transition point, we call it rather than crisis point, you have the option to reassess and
yeah,
reshape and redirect, like you're saying, with those kind of decisions, and kind of go back and sort of start
yeah,
up again in a new, or alter how you're operating.
yeah,
Or you may decide to sunset, or you may decide to merge with another organization, for example. So you could have
yeah,
few scenarios, but we call it a transition point usually. If you
yeah,
get to a crisis point financially, that's probably, hopefully you could have mitigated against that earlier. But if you can't, then you might be dealing with yeah, like we try to not even, ideally not get to a crisis point. But if you do, there are still things that you can do,
yeah,
I think, in our experience. But you do have to make some pretty difficult decisions. Yeah.
yeah. Thank you, Gretchen.
Yeah, thank you for that. We have got another question. What do you think is a healthy proportion for cash in hand versus short-term investments versus long-term investments, especially for organizations with irregular cash flows? So cash on hand versus short-term versus long-term investment.
This is a good question, and I don't have a perfect answer for you. I'd say in hand and short term would be that 3 to 6 month reserve. Long term is a little bit more about what you have as an organization, I would say. So, where we say maintain reserves generally of 3 to 6 months, I would say keep that as cash in hand, like in your checking account, and in short-term investments, maybe, 30-day maturity, whatever, 3 month maturity. The long-term part is really, do you have that luxury? And so I would say look at your cash flow, look at your funding cycles, and then make a decision from there. We did a webinar recently on investment policies. Actually, this was actually feels like a long time ago. It was just last week. But we brought in our governance expert who has worked with a number of larger foundations. You might get some interesting pieces from there, actually. So I'd encourage you to check out that resource.
Great, thank you so much. Thank you, everyone, for coming today. We can stay definitely a few minutes longer if people have more questions, but did I miss any questions? Let me just double check. Uh, Oh, yes, there's a person who said they'd be open to to providing more information about the situation to get advice. So the one that's in crisis, I would say the one that's mentioning the crisis, feel free to please contact both Enkel and Vantage
Yeah,
Point, see if we can help you. Both of us have different
absolutely.
types of services. Obviously, we're not on the financial side, so it depends what you need. And Omar can definitely help you in financial crisis. And then we do have one more question. How far in advance should an organization prepare cash flow statements? I'm not sure, Heather, if you're referring to, do you mean, are you saying what duration of time should you have a cash flow statement for, or like how far in advance of your fiscal year? I'm not, do you have,
So
what
let
would
me
you
just,
say, Omar?
yeah, I would say that every organization should be prudent and have at least like a monthly cash flow plan um, in times of crisis or, in an organization where there's extremes in cash flow fluctuations, it might be more frequent than that. I would say every organization should be looking at it at least monthly.
Did that answer your question, Heather? If not, please jump back in. Yes. Do you have anything that you'd like to add, Omar?
No, it's other than continue doing the great work you do. It's so inspiring to see. This is a time that requires sort of a different hat from a finance perspective. You will receive some follow-up materials from us in the coming days, and please don't hesitate to reach out.
Yeah, we hope that this is obviously in a webinar. We're not going to solve everybody's questions, but I feel we've actually covered a broad range of topics here today, and a lot of really good tips and tricks. So everybody will receive the recording and the slides, and then a couple probably links to some of the webinars that have been mentioned. They've also been shared, I believe, in the chat. So, and feel free to reach out to Enkel or to Vantage Point if we can be of service to you or answer any further questions.
Thank you, Gretchen, and thank you everybody for attending. Have a great afternoon.
Have a great rest of your day.